A pan-industry survey published recently outlined the crisis facing many firms because of significant cost increases and new restrictions on professional indemnity, PI, insurance. The survey was carried out by the Construction Leadership Council, and today I'm joined by Samantha Peat, who leads the CLC Professional Indemnity Insurance Group. Samantha is also CEO of the Wren Insurance Association, whose members include many of the leading architectural practices in the UK. So Samantha, can you tell me what the key findings of your survey were?
Yeah, so just to give you some context, we had a really good response because we used a lot of trade associations to distribute the survey. So we actually got over 1,000 responses to the survey. Most of the respondents were SMEs. The majority of the respondents bought £10 million worth of PI cover or less, with very few buying £20 million or more. We found that almost 50% of respondents had had insurance declined, or insurers had declined to quote in 3 or more occasions. And we found that premiums had increased significantly. They'd increased 4-fold at the previous renewal, having doubled the renewal before that. But actually, really what we were interested in was what was the premium as a percentage of turnover? Because if you come to me and you say, my premium's gone up 5-fold, my answer is, well, you know, if you were paying 0.5% of your turnover for your professional indemnity insurance and now you're paying 2.5% of your turnover for your professional indemnity insurance, you're actually doing okay. But what we wanted to find out was, were there firms that were paying a significant proportion of their turnover for their professional indemnity insurance in such a way that that would be unsustainable? And we did find that 1 in 5 were paying at least 5% of their turnover, and some were paying towards the 10% of their turnover. So that's unsustainable. And furthermore, 3/4 of respondents said that they were carrying a claim excess that was imposed upon them by their insurers rather than what they would want their claim excess to be. And again, that has to be a concern, because if the claim excess is very high, if you have a number of claims in a policy year or a financial year, then that's going to be unsustainable. So that's really the context. But what we were really interested in, the premium is one thing, but what we were really interested in was, are people able to buy the cover that they need to do the work that they do? And we'd heard anecdotally that people were finding it very difficult to buy cover that didn't have a really broad exclusion around cladding and fire safety, and had some examples of policy wordings which we've been able to share. But some of the exclusions on the insurance policies would say, we will pay no claims directly or indirectly related to fire safety. Now, that is such a broad exclusion on cover that it affects everything that people do. And that's really what we wanted to get to the bottom of. We found that less than 5% of what they did was related to high-rise residential buildings. Almost 1 in 3 were unable to buy the cover that they wanted. And over 60% had some form of restriction on cover, with 1 in 3 of the total respondents having a total exclusion in place for cladding claims, and 1 in 5 of total respondents having total exclusion in place for fire-related claims. And over 1/4 of respondents said that they'd either lost jobs as a result of inadequate PI insurance, or they couldn't do the remedial work that's needed to be done on a number of high-rise residential buildings if they were asked to. And almost 1/4 of respondents had changed the nature of the work that they do because of inadequate PI insurance. So that's broadly the sort of the statistical outcome of the survey.
So although this situation's been driven by lots of factors, including a response to higher historic claims from the sector and a cyclical hardening of the insurance market. I mean, it sounds from some of those responses that Grenfell is one of the big reasons behind this.
Yes, so I think that Grenfell was definitely a catalyst for this retraction in terms of the scope of cover and the number of insurers that are interested in covering construction professionals. We didn't really see exclusions on cover going on to policies until sort of April 2018, so a good sort of 8 or 9 months after the Grenfell Tower tragedy. And when the exclusions started to be introduced to professional indemnity insurance, they tended to be quite specific. They tended to refer to ACM cladding and to be sort of very wordy and very specific about what was being excluded. But as I've said, over the period since then, the 3 years since then, what we've seen is this broadening of the exclusion, such that people say, well, I've got a contract to maintain fire extinguishers and I can't do that job anymore. And that doesn't have anything to do really with what happened at Grenfell, and yet I am being prevented from doing because of the exclusions on my professional indemnity insurance. I do think that COVID has played a part. I think that COVID has affected insurers in a number of ways. I think it's affected their investment returns, which is problematic. I mean, the investments have picked up, but I think there's a nervousness around the investment income that insurance companies have. A number of insurers have been hit with business interruption claims, and there's been court cases forcing insurers business interruption claims that they don't think that they should be. And also, I think working from home has made insurers a little bit more risk averse. And I think it's also made it slightly easier for them to say no. And so where relationships, particularly with the brokers, may have got you somewhere in the past, unfortunately, I think in the insurance has been a bit more commoditized in the last year or so. And that has made it difficult for people to get the cover that they need.
So as you say, COVID-19 has been bad enough for the industry, and this second crisis isn't going to help recovery. So what steps is the Construction Leadership Council planning to relieve the situation?
So I think the first thing to say is that the group itself is very diverse. So we have people representing construction professionals, but we also have people on the group representing brokers and insurers. And we also have people on the group representing government. And MHCLG and BAYS have been really engaged from day one. We've had their ear. They're very keen to understand the situation, and they're very keen to fight our corner if that's what needs to be done to find a solution. I think the issue that we have is that if we are asking for government intervention because we don't think the insurance industry is going to solve this problem by itself in the short term, that we're talking about taxpayers' money, and you have to justify using taxpayers' money, and you have to be able to demonstrate that number one, this is a problem. This isn't just a small group of people whining about their insurance. This is a problem and it needs to be rectified because there are serious implications to it. But also you've got to be able to define to government what is the exposure, what will be the cost to the taxpayer, and what is the exit strategy for government to withdraw once they've done what they need to do and allow the insurance industry to perform again the way it did pre-Grenfell and pre-COVID. But our biggest concern is that what's happening with the professional indemnity insurance market at the moment is affecting two streams, as it were. It's affecting SMEs in that it's preventing them from doing work that they want to do. And our concern is that a number of SMEs could go out of business when you look at the combination of high premiums, high claim excesses, and drop in workload. So that's a big concern of itself. Our other concern is that if people don't have cover for fire safety related work or cladding related work, who's going to do the remedial work that needs to be done on the buildings that need their cladding removed and replaced? And it's only really once you've addressed the remedial works that need to be done that you in turn address the professional indemnity insurance notifications that have been made to insurers about who is going to have to pay eventually for the remedial work that needs to be done. And our concern as a group is that if professional indemnity insurance is a problem that is stopping that remedial work from happening, then we've got a bottleneck and we need to address that.
Now, former president of the RABA, Marco Goldschmidt, I mean, he's carried out a survey and received considerable support from smaller architectural practices for a new mutual insurance model similar to your own REN. And he quotes your Flaxman report about the problems practices face of increasingly onerous client contractual terms, as well as the transfer of responsibilities of subcontractors and other services. They've now become architects' ultimate responsibility. So is Goldschmidt's plan realistic, do you think, from your point of view?
I think it's a great plan. I mean, I believe I'm chief executive of the REN Insurance Association. It was established in 1987. It's been a fantastic mutual, very successful mutual in meeting its strategic objectives. And I believe very strongly that a mutual insurance vehicle is the right vehicle for professional indemnity insurance for a group of like-minded professionals who are interested in managing their risk and sharing their risk. I absolutely fundamentally believe in that. I think sadly, the environment today is very different from the environment back in the 1980s when REN was established. So REN, we started to think about REN in the mid-1980s. We started writing business in 1987, and that was off the back of a letter from the Department of Trade and Industry saying, yes, you can go ahead. And you have to sort of cross your fingers and hope that you don't have too many claims in the early years before you've built up your fund of premiums to pay those claims. Now, unfortunately, today, insurance is far more regulated, and there are such things as Solvency II capital requirements. And so in order to start underwriting an insurance mutual, you would have to have a lot of capital on day one in a way that we didn't have to back in the 1980s. And so although I absolutely think that it's a fantastic idea, it could be prohibitively expensive if the founder members of that mutual had to fund the mutual up front.
So would you take on smaller practices?
So with REN, we have strategic objectives that we need to meet. And we also need to make sure that the members of the mutual are like-minded, both in terms of their risk profile, their approach to risk, but also their ability to contribute to the costs of running the mutual. And so we have to make sure that we can bring in enough money from each member practice to cover the services that are provided. And those are services that the existing members of the mutual have agreed that should be there, but they are expensive and they have to be paid for.
So the answer is no.
We're always happy to talk to practices, but there is a compatibility issue.
Well, Samantha, thank you very much for telling me about this really very critical issue, and thank you very much for the work you're doing to try and sort it out.
Thank you.